My CPA cost me a few $1,000s by filing a tax form incorrectly. He didn't do it intentionally. However, I could have avoided this loss if I had taken a few minutes to understand how to read the tax forms. I encourage you to review your tax forms carefully. So in this video, I will discuss how to understand the 1040 form and some schedules that you may need to file with your tax return, the difference between tax deductions and tax credits, some tips to save on taxes, and what I missed on my tax return that cost me a few grand. My mantra is trust your accountant, but always verify. I present this content for information and entertainment only. Everyone's tax situation is different. Consult a professional for your unique case. If you're familiar with me, welcome back. If you don't know me, I'm Avanti. I'm a mom, an investment advisor, and a CFA charter holder. I have over a decade of experience in the financial industry. Follow me to learn how to simplify your finances and build wealth. This is Form 1040 for 2023, which you will file with the IRS this year if you are a US taxpayer. Let me show you the basic layout of this form. The top section indicates your filing status. The most common three being single, married filing jointly, and head of household. The head of household status is for single people with dependent children. There's also married filing separately, but it's not a favorable filing status. And the last one is qualifying widow or widower with dependent children. This one's for someone who lost their spouse in the past tax year. Next, we have your personal information, name, tax ID, address, etc. Then you have your total income, both active and passive, with adjustments for investment and other income and expenses. Certain types of income are excluded. Examples of exclusions are life insurance proceeds, municipal bond income, or other non-taxable income. List all income from various sources: wages, tips, commissions, investments, real estate, gambling, etc. Then you have your above the line deductions. Typically, these are deductions related to retirement plan contributions and self-employment tax. If you contribute to an employer-sponsored retirement plan, Box 1 of your W-2 reflects a reduction in taxable income. Your W-2 may explain how they arrived at the number in Box 1. One way to reduce your taxable income is to maximize your deductions. If you maximize contributions to a 401k, your taxable income goes down. Once you subtract all your above the line deductions, you arrive at your adjusted gross income or AGI. AGI is the line. Anything above the AGI is an above the line deduction, and any deduction below the AGI is a below the line deduction. You will subtract the greater of the standard or itemized deductions from your AGI. You can take itemized deductions on mortgage or investment interest, medical expenses, casualty losses, state and local taxes, and charitable contributions. For medical expenses, to qualify for itemized deductions, they must exceed 7.5% of the AGI. If your AGI is $100,000 and you incurred unreimbursed medical expenses of $10,000, you can only itemize $2,500. Medical expenses include insurance premiums, copays, costs of modifying your home to accommodate medical conditions, etc. I spoke about medical insurance in this video. If you pay state or local taxes, those taxes are deductible up to $10,000. You can deduct sales taxes if you live in states without state tax. Next, you can deduct mortgage interest on loan amounts limited to $750,000 used to buy or improve your home, and you can do that on up to 2 houses. Charitable contributions and casualty losses also have their own rules for itemizations. You add all the allowable deductions on Schedule A and compare the total against the standard deduction. For single or married filing separately, the standard deduction is $13,850. For married filing jointly, the standard deduction is $27,700. For head of household, it is $20,800. Make sure that you take the higher of the two deductions. My accountant failed to maximize my deductions, costing me money. If you like the video so far, please support my channel by giving me a thumbs up and by subscribing. After subtracting below the line deductions, you get your taxable income. You then calculate your tax based on your tax bracket. Your tax software will be able to do this for you automatically. Next, you have your tax credits. While deductions lower your taxable income, credits reduce your tax. Let's say your effective tax rate is 30%. A deduction of $3,000 will lower your tax by $900. On the other hand, a $3,000 credit will reduce your tax by $3,000. So the same amount of credit makes a greater impact on your tax bill. You can take tax credits such as child tax credit, child and dependent care tax credit, electric vehicle tax credit, education credits, etc. After applying credits, you get the total tax you owe the IRS. If you have overpaid your taxes, you will get a refund. If you underpaid the IRS, you will cut a check or pay the balance to the IRS electronically. That's it. That's your 1040 in a nutshell. In addition to the Form 1040, you may be required to file one or more of these schedules. Schedule A is to report itemized deductions. Since the standard deduction was almost doubled in 2017, many of you don't file Schedule A. Instead, you opt for standard deductions. Itemizing deductions may be beneficial if you have a huge mortgage balance or have sizable charitable distributions. Schedule B is to report interest and ordinary dividends. For example, if you receive interest from your bank, the bank sends you a 1099 INT form. Also, ordinary dividends go on this schedule. I talked about ordinary versus qualified dividends in this video. Qualified dividends get taxed at a favorable rate. Schedule C is for reporting profit or loss from a sole proprietorship. For example, if you have a YouTube channel or sell stuff on Etsy but don't have a separate tax ID, you would report any profit and loss from that business on Schedule C. Schedule D is for reporting capital gains and losses. If you have investments in stocks, mutual funds, or ETFs, those will go on Schedule D. If you have any capital loss carryover from prior years, you can enter that to offset any gains to reduce your taxes this year. Schedule E is for more sophisticated investors, people with rental properties, partnerships, S corporations, or estates and trusts. I suggest you consult a professional if you fall into this category. A professional will make you aware of many opportunities to save on taxes. SE reports your self-employment tax. This is your FICA tax, Social Security and Medicare. If you're self-employed, you must pay both the employer and employee portions of the FICA tax. Whether you self-file your taxes or hire a professional to do them for you, review your taxes carefully. Don't miss any deductions, exclusions, or credits. Please let me know if you found the content helpful. If you enjoyed the content, please give me a like and a follow, and that will do for now. As always, don't forget to be happy, kind, and your best self. I will see you in my next video. Bye.